Welcome to this explainer. Look, today we're stepping in as your personal financial concierge to really demystify a subject that keeps millions of people up at night. We are talking about how you can protect your global wealth from being taxed twice. Basically, we're diving deep into the Double Taxation Avoidance Agreement and showing you exactly how to make sure you're legally keeping as much of your hard-earned money as possible. A staggering $125 billion. That is the record amount of remittances India received in the 2025 to 2026 financial year alone. And because of this massive flow of cross-border wealth, millions of NRIs and global earners are currently sitting there, reflecting on their income tax filings, looking at their international paychecks, and wondering what the tax man back home is going to say.
And honestly, that reflection leads to one of the biggest post-tax season anxieties out there. Did I just pay tax twice without needing to? It is incredibly stressful wondering if the hefty taxes you already paid in the US, the UK, or Germany mean you still owe another huge chunk of change to India. Well, the answer to that lies in the framework we're unpacking today. Here is our agenda for today. We'll hit the double tax dilemma. Look at how DTAA actually works. Check out some real scenarios with the UAE versus the USA. Cover the compliance trap, and wrap up with myths, facts, and your action items. Let's get right into it.
Section 1. The Double Tax Dilemma.
So what exactly is a Double Taxation Avoidance Agreement, or DTAA? Well, it's basically a bilateral treaty that overrides domestic tax laws. In India, this is empowered by Section 90 of the Income Tax Act. It essentially forces two competing countries to agree on exactly who gets to tax your specific cross-border income. If a DTAA provision exists, it takes absolute precedence over domestic law to offer you the most beneficial tax treatment. It's literally a legal shield designed to stop your income from being sliced in half by two different governments.
The really good news here? India has cast a super wide net. They've established these treaties with over 90 partner countries. Whether you're earning a salary in London, collecting dividends in New York, or running a business in Sydney, there's a very high probability that a specific treaty is already in place to help you avoid getting double taxed.
Now, you might be wondering, what if you happen to be earning money in a country that doesn't have a formal DTAA? Don't panic. Indian law actually provides a unilateral fallback relief under Section 91. Even without a treaty, you're eligible for a 50% credit of the lower tax rate between those two countries. So the government has these built-in safety nets, but you have to know they exist to actually use them.
Moving on to Section 2, how DTAA works.
Okay, this is where the magic really happens. Depending on the specific country's treaty, your relief is going to fall into one of two buckets. The first is the exemption method. This is the dream scenario, right? Income taxed in one country is completely, 100% exempt in the other. You only pay once. The second bucket is the tax credit method, which is honestly far more common. Here, you might technically be liable for tax in both countries, but you get a credit in your home country for the tax you've already paid abroad. So you aren't paying the sum of both taxes. You effectively just pay whichever rate is higher by using your foreign tax payment as a direct discount on your domestic tax bill.
Let's put a real number to this to make it concrete. 8%. Understanding the math of the tax credit method is absolutely crucial. Imagine an NRI working in the US. They earn a salary and pay a 22% federal tax rate there. Now, let's say India's applicable tax rate for that same income bracket is 30%. Because of the DTAA, India doesn't demand 30% on top of the 22%. No way. Instead, the treaty credits the 22% already paid to the US. The taxpayer only pays the remaining 8% to India. That is a massive, massive difference from paying 52% total.
All right, Section 3, real scenarios. Looking at the UAE versus the USA.
Let's look at the UAE first. Here, we see the exemption method in full swing. Because the UAE levies zero personal income tax, a valid NRI salary earned in Dubai is entirely safe from Indian tax. It is essentially tax-free. But, and this is a huge but, please do not assume this protects your investments back home. Your UAE salary is perfectly safe, sure, but the rent you collect on that apartment in Mumbai or the capital gains from your Indian mutual funds, those are fully taxable in India. Since the UAE didn't tax them, there is no double taxation to avoid in the first place.
On the flip side, the US operates under a totally different philosophy. The USA taxes its residents, including green card holders, on their worldwide income. India, on the other hand, taxes non-residents only on India-sourced income. So if you're an NRI in the US with Indian rental income, well, both countries want a piece of that pie. This is where you rely heavily on the tax credit method we just talked about, offsetting the Indian taxes you pay against your U.S. tax bill so you aren't penalized just for having global assets.
And, DTAAs aren't just for folks permanently living abroad. Take these two super common scenarios. If you're an Indian resident working remotely for a foreign firm, say a UK company that deducts tax at source, you absolutely can and should claim a DTAA credit in your Indian income tax return. Plus, for returning NRIs coming back to India, you can strategically use the resident but not ordinarily resident or RNOR status. That gives you a precious 2 to 3 year window where your foreign income remains completely non-taxable in India.
Which brings us to Section 4, the compliance trap.
The absolute key to all of this is the TRC, or Tax Residency Certificate. Listen, this is not optional. It's the mandatory document you have to obtain from the government of your host country. It proves to the Indian tax authorities that you actually live where you say you live, and therefore you're legally eligible for that specific country's DTAA benefits. Without a valid TRC, the Indian Tax Department can, and for sure will, deny your DTA claims outright. Because establishing that you're a non-resident in India, it's entirely a numbers game. You have to strictly monitor your physical days spent inside India's borders. The standard thresholds are the 182-day or 60-day rules. However, if you happen to be a high net worth individual earning over 15 lakh rupees from Indian sources, there's a much stricter 120-day rule you've got to abide by. Literally, one extra day visiting family in India can accidentally trigger Indian tax residency and boom, immediately expose your global wealth to Indian taxation.
So, securing your wealth means following this exact sequence. Seriously, do not mix these up. Step 1. Obtain your TRC from your country of residence. Step 2. You must explicitly file Form 67 in India to declare your foreign tax credit claim. And finally, Step 3. Only after Form 67 is filed do you actually file your income tax return before the deadline.
I need you to remember this rule. Missing Form 67 means your DTAA credit is disallowed. Period. You will end up paying full Indian tax plus foreign tax. Non-filing a Form 67 is literally one of the top reasons tax authorities reject foreign tax credit claims during scrutiny assessments. If you just drop the credit amount into your ITR but forget Form 67, your claim gets thrown out. You end up double taxed entirely due to a simple administrative oversight.
And finally, Section 5. Myths, facts, and actions.
Look, the financial rumor mill is dangerous. A super common myth is that DTAA just happens automatically, that just because a treaty exists, the taxman knows to leave you alone. The fact is, as we just covered, you need your TRC and Form 67. Another massive myth is that returning to India immediately triggers worldwide taxation on day one. Actually, the RNOR status gives you a great transition period to plan your finances. Assuming these myths are true can lead to some terrible and very, very expensive financial planning.
So, to wrap this explainer up, your immediate action items are pretty clear-cut. First, make it a strict habit to secure your tax residency certificate every single financial year. Second, prioritize filing Form 67 before your ITR due date if you are claiming a credit. And third, take a little time to consult the specific treaty articles for your host country. The rules for dividends might be completely different from the rules for royalties or a standard salary.
Which brings us to our final parting question for you. Is your current residency status secretly costing you thousands in double taxes? I highly encourage you to review your days spent across borders and audit your compliance filings today. Because honestly, failing to claim your rightful DTAA relief isn't just a minor oversight. It's essentially leaving your hard-earned money right there on the table. Thanks so much for joining us on this explainer, and we'll see you next time.